Governor, thank you for talking.
Good to see you.
You have just decided to raise interest rates. You have told us that inflation is going above 7%. This feels like a big moment for monetary policy in this country. Can you explain what's happening?
We're having a very big shock, particularly from the prices of things that we buy into the country, so particularly energy, gas. I mean, wholesale gas price has gone up, I think it's around 400% in just over a year, for instance. And also quite a lot of traded goods that we buy in from other parts of the world. And by the way, one of the things that's gone on in the COVID period is that there's been a sort of shift from spending on services, going out and so on, to buying more goods. And that's around the world. I mean, this country is part of it, but it's by no means the largest part of it. And that has caused higher inflation. Energy prices, particularly the gas price, have been extraordinarily volatile as well. Now, I have to tell you that we can't use monetary policy to directly tackle the causes of these increases. But what we have to do is use monetary policy particularly to limit what we sometimes call the second round effects, the follow-on effects. And that's a hard message, I understand, for households, because it's a matter of saying this is having a negative effect on income, on real incomes.
Your decision is?
Well, the whole thing is. I mean, obviously the biggest negative effect is coming from higher inflation.
But you're then adding to that with higher interest rates.
But I would say that it would be worse if we didn't do it, because if we get, if we get prolonged high inflation, we get even higher inflation, that will be worse.
So that's the point. It's between two pretty undesirable outcomes we have right now. We
have to use monetary policy as we can do to seek a rebalancing of particularly of the domestic forces. Now, we believe that there will be a slowdown in demand this year because this effect of inflation on people's incomes, real incomes, will cause that. And actually, we believe that by the end of the period that we look at, 2 to 3 years, inflation will come back to target and it will stabilise.
And what's your message to many households watching this, feeling that already they're being squeezed, knowing that according to your forecasts, it's going to get worse, isn't it? What's your message to them, especially explaining the fact that you're adding to that pain?
Well, I would say that, yes, we are having this quite large shock coming from, say, particularly the prices of things that we buy into this country. Now, we believe that those prices will correct, but there are all sorts of risks around that. But we believe, our main belief is that they will correct. And what we have to do is ensure that in the meantime, there isn't more inflation pressure coming domestically. And that would come, for instance, from, I have to say, from things like wage bargaining. And we have to use monetary policy to, in a sense, chart through that to say, yes, there is going to be, I'm afraid, some negative effect on incomes. There is going to be a negative effect on growth in the economy, but we will come through it. We really believe we will come through this. It will correct itself. And that's essential, because otherwise it would be worse.
When you say worse, what do you mean?
Well, we would have higher inflation for longer, and that would have even more effect on households' incomes. And it would have even more effect on demand, and it would have even more effect on employment. And we don't want, we must avoid that.
There's this kind of internet meme, I don't know if you've seen it. You had one job. Well, the Bank of England has one job, keeping inflation under control. And yet, your target's 2%, you're looking at inflation being 7%, so you have one job.
Yes, but what we can't do, I'm afraid, is remove all the shocks that can happen to the economy. That we can't do, because there are shocks coming into the economy of all sorts. I mean, let's face it, we've had some very big shocks. We've had COVID shocks. We've now got a shock from energy prices. These are very big shocks. We're living in
about which you couldn't really have done anything.
No, we're living in an era of very big shocks. Now, our job is to stabilise inflation, you're right, to the target, but we have to do that over what we tend to call the medium term, that's 2 to 3 years. And we will do that. I mean, all our policy is directed towards doing that, but we cannot, I'm afraid, remove all the shocks off the scene because we don't control the causes of them.
So do you feel there was a kind of opportunity missed here, though? Because, although you can't control everything, you do occasionally look back at your numbers, you look back at whether you could have made a decision slightly earlier, maybe could have moved things marginally. Do you wonder about those things?
I'm afraid I do resist what I call hindsight judgments, both on our part and anybody else's part.
But it's just part of assessing whether you got it right or wrong.
We went through a very, very large period of instability and shock in the COVID period. Now, let me say also that monetary policy has its effect with a lag, and that lag can go on for up to at least 2 years. If we rewound the sort of the play, as it were, and said, well, you could have tightened monetary policy 2 years ago. Well, what was happening 2 years ago? We were just going into the teeth of the COVID shock. And of course, had we done that, let's say, we would have made the COVID recession even worse. And that would have had consequences today. But let me say today, let me tell you some good news. Employment and unemployment today are much better than we feared they would be during the COVID period. I mean, we've come through the COVID period better than we thought. So that's the challenge in making policy.
Final question. You for a lot of your career, dreamed of being governor. Did you have any kind of anticipation that when you became governor, you'd have to deal with an extraordinary potential financial crisis with COVID, and then this, which is the toughest, potentially the toughest moment for independent monetary policy since the bank was made independent?
Well, it's interesting. I'm coming up to my second anniversary in early March. There hasn't been a quiet period yet, put it that way. We've had some tough times, but we're here to deal with them. I mean, that's what the Bank of England is here for, and we get on with it.
Okay, Governor, thank you very much indeed.
Thank you. Good to see you.